Everyone, Jonas and Ashley here, ready for another exciting update for our Epic Updates series. Today we're going to be talking about everyone's not favorite organization, we'll call them, the Fed. So the Fed obviously carries a lot of weight in the economy overall, and particularly in the real estate market. They've been kind of bouncing around with the Fed funds rate, which indirectly impacts mortgage rates, but it's basically the cost to borrow money between banks, but they kind of run parallel with where mortgage rates go, credit cards, cars, student loans, that sort of thing. We've obviously talked about this in the past. The projections in the beginning of the year was that the Fed was going to get more aggressive with some of these rate reductions. They were talking about maybe 4 to 6 over the course of the year. Well, we're already in May now, and there has been 0, and we don't have any on the horizon currently. So, things did improve, when the interest rates kind of started to come down a little over 1% towards the end of last year. We had a good run through about February. Ash will kind of get into the rate situation a little bit, and then, since then it's kind of reversed course.
Yeah.
The good news is the economy is doing well. The good news is people are hiring like crazy, so the jobs market is doing well. However, those two factors, along with the inflation rate, ultimately impact the Fed's decision as far as where to go. So we've talked about this before. We'll talk about it again. In my opinion, the Fed is not only the arsonist that kind of helped, create this, frenzy, but now they're the firefighters, or they're trying to be the firefighters. So, till we see them kind of change course with that again, things are probably going to be pretty slow for the next, several months until we see improvement on that. They've jumped around, pre-pandemic. We're basically at almost a 20-year high. Currently where they're at right now, about 5.5% with the Fed. Was more or less around that leading up to the Great Recession. When the Great Recession hit, they slashed it, dropped down all the way down, drop to about 0.25%. Right around the pandemic, kind of bumped back up again to about 2.5%, and then back down again to 0.25%, and now we're back up to 5.5%, which is really kind of stalling things. So where does that leave us with rates?
They're still really high. They did come down towards the fall. As we entered into the new year, we were seeing a lot of things like
uptick.
An uptick. We started to get busier. Rates were a little bit better, and we were seeing much more seller concessions. So as the interest rate now has crept up, today we're up over 7% on a 30-year conventional. We're not seeing as much of the seller concessions anymore. So for those that are looking to really take advantage of this market as far as the pricing is concerned and kind of leverage that higher interest rate, we're seeing a lot of success on the new build side for rate buy downs, which we've talked about before. And if you have further questions about that, whether it be on a new build or a resale, let us know, and we can help you or put you in touch with our broker. But new builds is where it's at right now if you're looking for something with a competitive rate.
Absolutely. Yeah, I mean, most of these companies are huge, publicly traded, so they got to move homes, so some way, shape, or form. So how do they do that? It's either pricing or incentives. So, they're doing rate buy down stuff. They're offering different upgrade packages. We're seeing backyard, landscape design packages, fridge, washer, dryer being included again. I think as we continue into this lull, I do think that it'll open up more of the seller concessions in the next few months. Just kind of, what we're seeing even with some of our sellers, stuff that we arguably comped accurately, and just not moving as quick. Ashley and I have been doing market surveys with other brokers, just kind of with similar listings in the area, just to kind of get their overall feedback, because obviously what we see is just kind of our lens, so we kind of want to get a broader scope, and it kind of feels that way across the board, that a lot of them are seeing the same thing. So
it definitely seems to be kind of like a universal vibe right now on the real estate side. We're all kind of feeling the crunch, and we really do feel as though it's a direct correlation to the Fed and interest rates and all that.
We do. The one thing that we do know, just because we saw it again kind of November through February, it's not going to take a lot to break up the logjam, you know what I mean? As far as, to get buyers off the fence again. Rates came down that full percent. They're still in the 6s, they're still in the mid 6s, and we saw a ton of, not a ton, but a decent amount of activity surge.
Yeah, uptick for sure.
So when that happens again, I'm sure that'll also happen again, and then as we move closer down, hopefully closer to the 5s, it's going to be gangbusters. So buckle up.
Yeah, and if you have questions about, again, the best way to buy, the best type of property to buy, what's going to be best for you in your scenario, reach out to us. If you find value in these videos and you have another topic you'd like for us to discuss,
send it our way.
Yeah, go ahead and send an email or send a text. But either way, thanks for watching, and we'll see you in the next Epic Update.
Thanks, guys. Bye.